more people log on. Welcome to our today's Lumsden and McCormick webinar, Federal Tax Laws Gone Wild, Tax Planning for 2021. My name is Christine Prue and I will serve as your host today for the webinar. Before we get to introductions, I'm going to run through a few housekeeping items. The webinar today will be recorded and we will be sharing a link with all attendees once it is on our website along with the slide deck. Both the chat feature and Q&A feature are enabled today. If you have questions though, please specifically type them into the Q&A section to ensure that our panelists see them. We'll be answering all questions at the end of the webinar unless something fits in during our presentation. Now moving on to CPE, we are offering 1 hour of CPE credit for this webinar. Therefore, all polling and survey questions need to be answered if you'd like CPE credit. You'll have 4 polling questions during the presentation and you are required to answer 3 to qualify for CPE credit. You'll be prompted for each and results will be shared. At the end of the webinar, please complete the short survey, which will automatically launch. The survey will serve as the webinar evaluation and again is required for all of you requesting CPE credit. 1 hour of CPE credit will be issued for all CPAs and we will email you a certificate in the upcoming weeks. Now, as many of you already know, this is the first part of a 6-part webinar series that we are having. I am going to be sending out right now in the chat a link for you to read and register for the other upcoming webinars in this series. Now, before turning it over, I would like to start with our first polling question, which is, will you be attending this webinar for CPE credit? I'll give you a little bit to answer that, yes or no.
I can't vote.
Don't worry, Corey.
Corey, you'll get the CPE.
I want my CPE.
We'll make sure you get it. Okay, it looks like most of you have voted, so I'm going to close that off. Okay, and now we are going to turn over the program. I'm turning it over to Mark Janulowitz, who is going to talk about business tax planning, and Corey Van Duzen, who will then also talk about personal tax planning. Mark and Corey are both partners in our tax department, and they're very knowledgeable on this topic. So I'm going to turn it over to you two.
Thanks, Christine. And thanks everybody for joining in. I'm Mark Janulowitz. I've been with us for about 30 years, so I've seen a lot of tax law changes, but boy, the tax law changes seem to be coming faster every year. So this we're focusing on here today is to talk about the President Biden and his administration, what their proposals are to raise the revenues to pay for certain benefits in other areas. At the end of March, President Biden proposed the American Jobs Plan, where he would increase taxes on the corporate profits to pay for infrastructure of about $2.3 trillion. Then at the end of April, he announced the American Families Plan, which was at an estimated cost of $1.8 trillion. That was a plan that was there are proposals that we're going to discuss here that have to do with the increase in tax on wealthy individuals and on capital gain rates and other things to help fund the program. There are a lot of things in that that are benefits for the American public, including things like more for American children for additional free education and additional child tax credits, paid family leave act. So there's a lot of things that go along with that, but we're going to focus on the side of the revenue raisers, which means the higher taxes in certain areas. So Christine, if you go to the next slide. Well, I guess we'll go to polling question 2 just to get it started, and then we'll talk about this. Will the Buffalo Sabres ever make the playoffs again?
No.
I know what my selection would be, but I'm not allowed to vote. We'll give that a minute, and Christine, you let us know when we should get going on this.
And Mark, just to be clear, none of this stuff is passed yet. This is right. All what Biden wants. So in the final analysis, this stuff might all change.
That's
We
right.
we have no idea. I mean, he's got support of Congress, which he'll go over, but it's not set in stone yet. And some of the proposals that we were talking about 4 months ago seem to have dropped off his agenda, or they just forgot to mention. We're not sure yet.
But and I think that the timing of this discussion is really important, Corey, and everybody, because, we do have to start thinking about this stuff now, especially when it comes to the capital gains and estate tax issues and corporate profits. So, we're really, the reason you have the discussion now is you don't want to start tax planning, or at least thinking about this kind of stuff on December 1st, 2021, because at that point it might feel like it's a little bit too late. Starting this discussion now in May and knowing what we think may be coming at us is really important. But yeah, as Corey said, we're keeping our ear to the ground and certainly making sure that everyone is aware of what the changes are going to end up being. So I think we have our poll results. It's about split, so I think we can move on to the next item. Mine would have said no, because I don't think in my lifetime, I think Doug Sosnowski said the same thing. So business tax planning, what do we know? We know nothing. It's just a scribbled across, the country about where taxes are and, where things are going. And, politically, the country feels so divided. If Christine, if you go to the next slide, you'll see where over the last number of presidents, you see where the Senate and the House have stood in terms of their political affiliation. And now with President Biden, the Democrats have control of both the Senate and the House. And you may say to yourself, well, the Senate's 50-50, but Kamala Harris as vice president has the tiebreaker vote. So it is still democratically controlled Senate. So, you have the Democrats right now controlling everything, which is a complete turnaround from where it was before this administration started, where the Republicans controlled the Senate and the House, and of course the presidency. And, with that, we're going to see a lot of revenue raisers to pay for other programs. If these proposals go through, the fighting that's going to go on in Congress right now is going to be pretty extreme over these next few months. President Biden has been out campaigning essentially for these different programs that he's looking to raise the revenues on. And as many of the Republicans have said, they believe there's too much spending. But again, that's a matter of opinion. What we're looking at here is just to present to you what the proposals are. So I think with that, we'll go to the next slide. And Corey, you're going to talk about some of the individual tax changes that have been proposed by President Biden and his administration.
Thanks, Mark. So just add a little bit of lid to the last slide too. I went to a presentation maybe 4 or 5 years ago that was presented by a Washington insider, and he predicted that over the next 20 years, you're going to have this whipsaw effect, which is exactly what that slide showed. Every 4 to 8 years, you have a different political party in power, and you're going to go from the right to the left to the left to the right and back and forth in terms of tax law. So chaos and uncertainty in terms of what future tax rates are going to be in 5 or 10 years might be kind of the norm. So building flexibility into your estate, your financial plan, and things like that, I think that is going to be important in the future, because we've already seen with Trump and now the proposed Biden plans, change seems like it's ever coming. So with that, so under current tax law, the top marginal tax rate is about 37% for income over 518 grand for individuals, and 622 for married couples. And this was actually lowered by the Trump administration from 39.6%. I think 39.6% was the top rate for quite a while at the individual level. And the Biden proposal right now is to restore the 39.6% tax bracket. And we're not sure exactly yet whether that will just replace the 37% tax bracket at that 518 and 622 level, or whether it will be a number higher than that. And there's been different numbers thrown around. Is it $400,000? Is it $600,000? Is it $1 million in terms of what Biden would like to raise taxes on in terms of taxable income? And also there's a little uncertainty on whether those numbers are just a single individual, so you know them for married couples. We're just not sure yet. So
Corey, I'm sorry to interrupt. I wanted to add one thing is that, you know, when we talk about these proposals too, they haven't given an effective date on these as well. So, you know, sometimes people have the question, well, when is it going to take effect? And, you know, logically you would think it would be January 1st, 2022, but we don't know that. We don't know when it could take effect. There have been laws in the past that have been retroactive. We don't feel that any of these would be. I think they would be, you know, they would be challenged in Congress and in the courts as being unconstitutional. But just keep in mind, you know, these effective, you know, dates can be any time. We just don't know exactly when it's going to be. So I just wanted to add that. Sorry,
thanks, Mark. It's okay. And there's we have seen commentary, and Christine, if you want to go to the next slide, we have seen commentary that Biden officials have said they don't expect any 2021 tax hikes because they would like to make sure the economy recovers. So like Mark said, all indications point to 1/1/22, but who knows? I mean, they could pass a law on December 1st and say cap gains after December 1st are taxed at a higher rate. So speaking of cap gains and dividends, that's what this slide is about. Under current law, the top tax rate is about 20% for long-term capital gains. So assets held more than a year or a year and a day at least, and then sold for a gain. For individuals, amount over $441,000 of taxable income, you're paying that extra 5%, so from 15% to 20%, and $496 for married filing joint. There is an additional 3.8% Obamacare tax or net investment income tax that might be due as well, depending on the nature of the asset that you sell. Generally speaking, if it's an active business asset, you're probably not paying it. If it's an investment asset and your income is over your AGI is over 200 grand for single and 250 for married filing joint, then you're also paying this 3.8% net investment income tax. So really the top tax rate currently for long-term capital gains and dividends could be 23.8%. And this is all federal. We're not talking about New York State today. And we are having a separate CPE presentation on the New York State budget changes because there were increases at the New York State level as well. So what is Biden proposing? Biden is proposing to eliminate the tax breaks for capital gains and qualified dividends for income levels above $1 million. So again, not sure if that's $1 million for single people and $2 million for married individuals. We're not sure yet. And instead of it being favored rate of say 15 or 20%, that would be your top tax bracket or your marginal tax rate, and that could be as high as 39.6%. So I made myself a little chart when I was preparing for this. So theoretically, in 2022, let's say you sell a business for $5 or $10 million bucks, you're paying 39.6% federal for federal purposes, plus a 3.8% possible Obamacare tax. But if we're selling an active business, probably not going to be the case. So if you're selling an investment portfolio, that's 43.4% compared to a marginal rate of 23% 3.8% right now. That's a big hike. You add in, if you have a large sale of a business and you add in the top tax bracket in New York State starting this year of 10.9%, theoretically, you could pay capital gains taxes of 54.3% on the sale of a large investment. That's a big number. And that's the biggest number I've ever seen on cap gains in my career. And I've been here 20 years now, it seemed, or something like that. So that was interesting to me. That hit home when I saw the 54.3 potential top tax bracket on cap gains. Planning note here that we have, possibly think about selling any appreciated assets before the end of 2021. And I say possibly because I've had clients call me and ask me, should I sell my whole entire investment portfolio? And I say, probably not. Probably what you want, my next question to them is, well, if you didn't have any tax rate changes, when would you sell it? I don't know, 15, 20 years. Okay, well then keep it, because what might happen is, remember that slide where we showed the changes every 4 to 8 years in power, you might get a Republican Congress and president back in office, so that might decrease the rates by the time you want to sell it. So I don't suggest liquidating the whole portfolio. If you were going to sell something in 2022 or 2023, I might think about accelerating that to 2021. And then after 2021, in order to spread out that income and maybe stay below that $1 million level, you might want to structure some sort of sale and an installment sale, so you're not recognizing all the income in a current year. Christine, you want to hit the next slide? So here, this is kind of just like data that's out there for some of the things that changed. Standard deductions. We got rid of the personal exemptions under the TCJA, and then the SALT cap came in. So right now, the standard deduction is about $24,000 or $25,000. A lot more clients have been taking that standard deduction because the state and local income tax deduction for, if you itemize to try and get over that $25,000, has now been capped at $10,000. So between real estate taxes and New York State income taxes, a lot of times that's over that 10 grand, that's capped at $10,000. This is a big question right now. Under Biden's plan, he's kind of been silent about whether or not he is going to try and eliminate that cap on state and local taxes. And a lot of New York State senators and Congress men and women have been very vocal that they don't think they're not planning on voting for Biden's plan unless they remove that cap. So really, Biden can't lose one Democratic vote in the Senate to get this thing passed. So if somebody digs in their heels, this could cause this SALT cap to be eliminated. And then we go back to, do I prepay my New York State income taxes before December 31st so I can take the deduction on my federal return? And that was some real valuable planning that we used to be able to do for clients that was eliminated now that we have this $10,000 cap, because you get the $10,000 basically just with real estate taxes with a white picket fence house and 2.5 kids and a dog. It's real easy to get there. Let's go to the next slide, please. We are now, we got to pull it. Oh, no, you skipped too far. Sorry. Now going to talk about some estate taxes. This is another area that could have dramatic change. We had a very kind of similar situation years ago with the fiscal cliff and whether or not the estate tax exemption was going to go back to $1 million. And a lot of people did a lot of gift planning right before the end of the year. We could be in a very similar situation here, because currently the estate tax exemption for any individual at the federal level is $11.7 million. So you can have $11.7 million of assets in your name, pass them gift tax or estate tax free to your to any of your beneficiaries. It could be your children, whoever you want. And those exemption levels are available for each person. So if you're a married couple, you could actually pass on almost $24 million without incurring any estate tax whatsoever to your heirs. That's a really powerful tool in terms of transferring wealth in a efficient way. New York State is a much lower level, but one planning opportunity right now is the exemptions scheduled to fall to $5.8 million in 2026. And there has been guidance out there that says if we gift away assets now, so let's say we have I'm a single individual, I'm worth $10 million. I gift away $5 million, so I still have $5 million in my estate, and I do that before that 2026 change or before any future legislation that Biden proposes, then I'm not going to pay any estate or gift tax at this point or when I pass, because it won't be recaptured. There has been details that have come out about that. What is Biden proposing? Possibly that death is kind of a deemed disposition. And Mark, you practice in the international tax realm quite a bit. Is there a deemed disposition in Canada?
Yeah.
Right.
Canada has that is their rule, that you're deemed to sell every bit of your assets at their fair market value, and you compare that to their adjusted cost base, and that gain is taxable in Canada. They have certain exemptions for your home and for a pension. These rules that are being proposed are a little bit different because they have different exemption as you're about to go through. But yeah, Canada has that is what their rule is. It's a deemed sale at death, that's what they're proposing here.
Yeah. So yeah, anything over $1 million could be subject to capital gains tax, and you would think theoretically you'd get a step up to basis because you're recognizing the income, but who knows? They can make up anything they want. So right now the estate tax realm is very unclear, and I think you're going to see at least the contemplation of many large gifts before the end of the year. The other thing that Biden has talked about that I don't think we have on the slide is, and this has been attacked by Democrats for a long time, would be the discounts given on a gift. So if you're gifting partnership interests or something like that, you can take a discount on it. So you might be able to gift $5 million assets, but only burn $2 or $3 million of your estate or gift tax exemption. So if you are in that like sweet spot, a $3 to $7 million, you might really want to take your look at your estate plan this year, especially if you're over that $11 million. You're definitely going to want to take a look at it because this could be a once in a lifetime opportunity, or we could have political upheaval again and have a Republican Congress come back and change everything back to the way it was now. So who knows? I do see a question in the queue, and this is a very intelligent question. Have you seen anything impairing Section 1202? 1202 is a qualified small business stock exclusion, and it is available to anyone that was receiving a stock from a C corporation that's always been a C corporation. And when they received that stock, they received it directly from the corporation. They didn't buy it from another person. And they held that stock for at least 5 years and a day. And also, when they received that stock, the gross assets of the business were less than $50 million. And if all those things are true, and you sell something, a stock for a gain, each individual shareholder, not as a whole company, but each individual shareholder can exclude up to $10 million of capital gain income from their taxable income. So if I invest $100,000 in a startup company and I hold it for 6 years and then I sell it for $10,100,000, I pay zero income tax. And currently, New York State is allowing that exemption as well. So you don't have to pay any New York State income tax. And I have not seen any chatter whatsoever attacking 1202 or saying 1202 planning is going to go away. And 1202 has been getting a lot of buzz in the Western New York and Buffalo area currently because the tech and startup community is really burgeoning in Buffalo, and there's a lot of exciting stuff happening. So some companies are being set up now with 1202 in mind, and being a C Corp from day one to try and get that 5-year clock ticking. So very good question. What do we got?
And the 1202, just to add to that though, the 1202, just keep in mind, is just for domestic corporations too. So foreign corporations fall under a different regime when it comes to that. So I think we're to our
polling question.
Yeah.
And if anyone can't read, do you think individuals making over $600,000 should pay more income taxes? Or if you can't see that little box on your screen, because it's hard for me to see.
I'm just going to give it a few more seconds so these last few people can answer.
You know, too, I'll comment, this isn't in the presentation, but along the lines of 1202, there's the qualified opportunity zones out there. And you can do some planning with that and deferral of taxes and elimination of gains. I haven't seen anything in the Biden proposals attacking that, but New York State did attack that and decouple from some of those benefits. So that's just something to be aware of too. And if you want to learn more about that, come watch our video webinar on the New York State budget changes. Look at that plug. I should be a
nice plug.
I should be a marketer.
So it looks like we've got our results there. A little more than almost 60% of you say yes, they should. So interesting statistic. Corey, nice job on the individual side. And again, that's just, there's probably other little nuances we're trying to cover. The large ones that are really going to affect a lot of the people that are talking here, or that we're talking to here. And I'm going to talk about the business side of it and what the proposals are. Currently, corporations have a flat 21% tax rate with no alternative minimum tax, which that was changed when Trump put into the Tax Cuts and Jobs Act. And that was meant for the US federal tax system to be more in line and more competitive with our foreign countries that have lower corporate tax rates. Most countries that we deal with have lower corporate tax rates than the old 35%. So it was lowered down to 21%. The Biden administration proposal is to raise that to a flat 28% on corporate income and reinstate a corporate AMT on profits of 100 million or more, $100 million or more. There are some proposals, you know, we hear some of our news through our BDO affiliation. And there are some proposals that I've read that say it might be for that AMT, that tax on alternative minimum tax might be on $2 billion of profit. So it might be for very large companies, but that's on book income. And that's a pretty big difference when you talk about book income versus taxable income. The reason you have tax advisors like us is our job is to bring down your taxable income down to its lowest level that's legally possible. Well, book income sometimes is stated quite differently than taxable income. And this proposal about the alternative minimum tax, it would be a 15% tax on your book income. So sometimes, you know, you see a lot of things in the news where Google and Amazon make billions and billions of dollars and they pay no corporate income tax. Well, some of that is on the book tax differences, and this is supposed to be a flat minimum tax of at least 15% on book income. Again, this is right now, it looks like, and again, we don't know what the final outcome of this is going to be, but the proposal is really geared towards very large corporations. But just the fact that they're they want to raise the corporate tax rate to 28% certainly makes for a lot of tax planning for our C corporation clients, because we may want to have more income now in 2021 if that corporate tax rate is going to be pushed up in 2022. There's also, there's a QBI deduction for individuals, which is a 20% deduction on qualified income. Right now, from what we're seeing, that's pretty much off the table. The removal of that QBI deduction. Right now, Biden's proposal is more focused on certain other aspects. I think it looks like they're still going to leave that QBI deduction, but who knows when the dust settles and they have this thing finally settled. There could be changes to the QBI, because the whole idea of the QBI deduction was to put flow-throughs on par with C corporations to allow. So if you're an S corporation owner and you were still being taxed at 37%, well, you're like, well, that's pretty unfair. If C corporations just went down to 21%, the QBI deduction was meant to level the playing field in that regard. So we'll have to keep our ear to the ground on that, but I think the QBI deduction is going to stay right now. Section 1031 like-kind exchanges, which deals with real estate. 1031 now is just for real estate. So if you sell a property at a $2 million gain, as long as you follow all the guidelines of 1031 by identifying a replacement property and purchasing it within about 180 days, and you buy it for more than you sold the old property for, you can defer the entire gain into the new property. Well, that's been a real estate staple for as long as I can remember, and I've got a few more gray hairs than Corey. I've been doing this 30 years, and the like-kind exchange has been a wonderful thing especially for the real estate industry to, be able to continue to buy and sell properties where you're reinvesting the proceeds into a new property. Well, now this proposal by Biden's administration is to limit the amount of like-kind exchange to and will not apply to gains in excess of $500,000. Now, I'm not sure if they're saying if the entire gain is over $500,000 that that the whole thing's going to be thrown out of 1031, or is it the first $500,000? But even so, many of the 1031 exchanges we see are in the millions of dollars, and so this could have a severe effect on the real estate industry in terms of trying to buy and sell properties, because if you have to pay tax on every gain, essentially, when you sell it, and then look to what you have left to reinvest the proceeds, well, if you add that with the potential with the higher capital gains rates and the high, for individuals, and for corporate, the higher corporate tax rates, there's not as much left to reinvest in the new property. So that's a really big one. We've got to really keep our eye on that, because if you're considering buying and selling property, that may be something you want to do before, at least plan to do before the end of 2021. And certainly real estate transactions don't happen on a dime. You've got to change, you've got to plan for those, because those take time to identify new properties, or if you're developing new property. It's really something we have to be careful with the 1031 exchanges.
Yeah, Mark, can I make a comment?
Yeah.
Because I was just thinking about this. There's a lot of business owners on this phone call or on this webinar, and we get this question all the time at the end of the year, November, December. Hey, I was really thinking about buying this $500,000 piece of machinery or doing this update. And should I do it? How much tax is that going to save me? And we do a quick calc and we tell you how much tax you're going to save. And that's expensing that $500,000 piece of machinery all in 1 year. and I know Mark, you said that this is probably going to hit big corporations, but if it's at big corporations now, and it ever trickles down to smaller corporations, that $500,000 deduction on that big piece of equipment to help you finance that, because there's going to be a big tax savings and it's going to motivate you to make that investment, that could be gone because book depreciation is straight line. So whatever the life of the asset is you divide that by whatever, 5 or 10 or 7. Where's Mike Grimaldi to tell us what the lives are? So that I wanted to make sure that hit home with people, because that is a lot of people will make decisions. I'm going to accelerate the purchase of this equipment to an earlier tax year because I'm going to save a lot in taxes. That could be gone. Hopefully it's not. And hopefully it's just on the big corporations like Apple and things like that. But I did want to hit that home. All right, I'll shut up now. Thanks, Marky.
Yeah, I mean, all of this that's why we're trying to make people aware of this now, so that you're thinking about these things and considering these potential changes, or I should say changes, these changes in the tax law, so that we can tax plan around that and lower your tax liability over a number of years. Good tax planning is done over a number of years. It's not just done. I mean, you do it in the particular year, of course. I mean, I don't have a DeLorean. I can't go back and forth in time, but you do want to plan for the next number of years and where the proposals are. And this is, Biden's proposals are sweeping changes, just like at the end of 2017, when the Tax Cuts and Jobs Act came into effect. Those were probably the largest changes since the 1986 tax law, which is ancient, but it's something that we don't usually see these big tax law changes, but now we are seeing those big swings, as Corey had mentioned, that everything is very politicized, and as I think we can all agree that there's a lot of division in our country when it comes to political agendas. And the way it's doled out in many ways is through the tax law. And so that's why it's very important for you as business owners to be aware of all of these things. So another business proposal that is on the table right now under Biden's administration is currently, if you're an S corporation owner or you're a limited partner in a partnership, or a limited partner in an LLC, you're allowed to avoid Social Security taxes on your share of the earnings. I'll just focus on S corporation owners. S corporation earns $500,000. They pay the sole owner $100,000 as a reasonable wage. The other $400,000 is flowed through to them on a K-1 that they pay tax on for income tax purposes, but they do not pay self-employment taxes on that, which is a real benefit of S corporations, especially for operating entities. Well, the Biden's proposal is that they eliminate this loophole and that they start to tax S corporation shareholders on their share of earnings, just like a regular general partner would, or a general partner of a limited liability company would. They would pay self-employment tax on all of their earnings, where S corporations have that loophole. This is one that they're proposing that, again, we'll have to keep an eye on, because that's always a nice planning opportunity, as long as we can get the S corporation shareholders income to at least what's considered reasonable compensation. The rest can be paid out without having the self-employment tax. We also, in that regard, though, we also have to be aware of the QBI deductions, because QBI has certain limitations on the amount of wages paid as well. So there really are a lot of moving parts when you're planning that part of it, but we just wanted to mention that. If you go to the next slide, I think can you go back one, Christine? Yeah, thank you. So under the current law, there's a temporary limitation on the deduction of excess business losses, which is scheduled to expire after 2026. So what this is, they put this in place under the Tax Cuts and Jobs Act, and it said, if you're single, the first 250,000, or I'm sorry, anything over $250,000 of losses on your closely held business are limited and carried forward. Or if you're married filing joint, you can go up to $500,000 of losses. That you're only allowed to take the first $500,000 of losses, and the rest has to be carried forward. That's a loss limitation, a business loss limitation that's going to expire after 2026. That limitation on the deduction of excess business losses would be made permanent under Biden's proposals. Whether that holds true or not, we don't know, but that is one where that can really hurt a lot of small business owners, especially if they're in the startup phase and they're counting on those losses to help fund maybe other businesses or build up a net operating loss carry forward. The one thing we mentioned there in the slides is that under the CARES Act, when the pandemic started, the CARES Act was enacted, and this rule for the limitation on the excess business losses was suspended for 2018, 19, and 2020. So, but starting in 2021, again, if you're an S corporation owner or an LLC owner and you have losses in excess of $250,000, you have to consider this limitation on those losses, on being able to use those losses. Couple other ones on the next slide. This may not apply to many of you. Some of these are in the international realm. These are a little bit near and dear to my heart because a lot of, if you're on this call and you're a client of mine, you probably have these issues. GILTI is an acronym for Global Intangible Low Tax Income. It's one of the more interesting acronyms, but it's essentially a tax where you have a U.S. parent company or individual that owns more than 50% of a foreign corporation, or at least a group of them own more than that, and it's considered a controlled foreign corporation. There is a tax on those foreign profits. Right now, the effective tax rate on that GILTI income, and again, I'm not going into any of the nuances of it, that's just a brief overview of it. The current tax on GILTI effectively is 10.5%. Biden's proposals are to increase that to 21% to at least get it to the current corporate level tax rate. And that may go up from there. But if your company is subject to GILTI because you have a foreign subsidiary or you individually own a foreign subsidiary, these GILTI modifications could have a really big effect on you because clients are surprised when they say, "Hey, I've got a Canadian subsidiary. It makes $600,000 or $700,000 over there, and it pays tax there, corporate level tax." But there's also this GILTI tax that it effectively treats it like a flow through to yourself or your company, and you pay a tax of, like I said, right now about 10.5% on that. And the proposal is to bring that up. Another couple of foreign ones that I'll just mention here that really aren't very applicable to too many companies. FDII is the foreign derived intangible income. That is an export subsidy for companies that only for C corporations that export outside of the US, that sell goods and services overseas. Biden's proposal is to remove the FDII deduction. So if you are one of the few, the proud, that take this FDII deduction, they're looking to repeal that. And there's also another one that has to do with very large corporations, whereby you can shift income to foreign related parties. They're looking to eliminate that and enact some new rules on that as well. I know, Corey, you wanted to talk a little bit about that fossil fuel tax incentives. You're our tax incentives guy, so you know this stuff way better than I do.
Thank you, sir. So yeah, what Biden is talking about here is elimination of a lot of the tax code and tax incentives for anything to do with fossil fuels, and then juicing up anything to do with green fuel. So wind, solar, or anything like that, geothermal, to continue those incentives and tax credits. And probably juice them up, and then eliminate things with the fossil fuel incentives. You're looking at intangible drilling costs, or percentage depletion, and things like that. Any of those publicly traded partnerships that you have for oil and gas companies, those are the types of investments that might be impacted and be less beneficial to invest in from an income tax standpoint.
And that's a lot of what Biden has been talking about. He's trying to go to more clean fuels, and so that's been a very political hot potato, but it's certainly something to keep an eye on. From a business planning point of view, right now, as we've been stating, the current federal flat corporate tax rate is 21%. New York State is 7.25%. While the individual top rate is 37%, and the New York State top rate is 10.9%. If you're a business owner and you qualify for the QBI deduction, the federal rate on that income is 29.6%. But some of the considerations in the tax planning that we talk about, Christine, if you go to the next slide, is and we've been doing this for companies. If you're a small business and you qualify, if your average gross receipts are less than $25 million a year, in certain cases, and analysis has to be done on this. It's not something we can just you want to just do. You want to actually, we have to plan for this, but you can change over to be a cash basis business, meaning you recognize income when you actually receive it, and you deduct expenses when you actually pay them. So for cash business taxpayers, if you think the tax rates are going to go up and you're a cash basis business, then you want to defer paying your expenses until 2022. That, number one, that gives you a bigger bang for your buck on your deduction, because let's say the corporate tax rates go from 21 to 28, you're saving another 7 points on that deduction by deferring it until 2022. And you also could increase, for flow through entities, you could also increase your QBI deduction as well. So, a lot of this stuff has to interplay with the old the Tax Cuts and Jobs Act, which was came into effect at the beginning of 2018, and a lot of businesses that went to cash basis, we got to start thinking about, okay, we want to accelerate income, which is, Christine, if you go to the next slide, you could accelerate income to 2021 and defer expenses until 2022. That way, again, you're getting a bigger bang for your buck if the tax rates are going to go up. So, it's so counterintuitive to any business planning, because you think about it and you go, well, of course you should be collecting your receivables. You want to collect them as quick as possible. Nobody wants receivables over 30 days. That's good, good business practice. But when it comes to tax planning, there, at the end of this year, it may be for our cash basis, the companies that are on a cash basis for tax purposes may want to do the reverse just for this year. On the next slide, you can see for accrual basis taxpayers, you can look at, different accruals. We mentioned accruals for compensation, and the rules are that if you accrue, say, bonuses as of December 31st, 2021, you have until March 15th of 2022 to pay those bonuses out to get the deduction in 2021. Well, you may want the deduction in 2022. Also, keep in mind for S corporation shareholders, no accruals are deductible. If you want the deduction, it's in the year that you pay it. It's essentially on a cash basis. And I reread, and I apologize for this, I reread the bottom of this slide on slide 20. If you think the tax rates are going to be increasing in 2022, you want to pay the bonuses after March 15th of 2022, so that you get the deduction when you get bigger bang for your buck. So there is planning when it comes to this, and some companies have substantial bonus programs where they pay out a lot of their earnings to their employees at the end of the year. Well, again, we may want to plan for that and make sure that we get the deduction at its highest rate, because you don't want to cut off the bonuses. You may just want to change the timing of when they're paid, and that can save you a significant amount of tax dollars. Again, these are just general business planning items, but if you look at, Corey, you already alluded to this, the 2021 asset additions. Right now, under current tax law, you have section 179 for federally, where you can expense up a little over the first $1 million of assets that you place into service by December 31st, 2021. And bonus depreciation is for 100% of all qualified new and used property that's acquired and placed in service in 2021. So depending on on each situation, the taxpayer can, you can strategize to minimize or maximize your tax benefit. But it's something that you have to think about. You don't want to think about this in a vacuum. If you are considering placing it into service, again, if right now we haven't heard anything that they're doing away with any of these large write-offs for fixed assets. But as Corey had mentioned, if the AMT tax comes down to smaller corporations, that could have an effect. So planning before the end of the year for large equipment purchases is going to be extremely important, because again, if you can get a bigger bang for your buck in 2022, it may make sense to purchase it in 2022. Again, right now, everything that we've read and through our BDO sources, it doesn't appear that they're going to change the section 179 rules or the bonus depreciation rules, but everything's always in play when they're negotiating things. This could be something where they consider it a revenue raiser if they were to start limiting this. But as of right now, we believe that those are still going to be in play. I think we've already talked about the QBI deduction. You just have to keep an eye on that and make sure that you are paying enough wages so you're not limited on the QBI deduction. We asked the question, is the QBI deduction going to go away in 2022? As of what we're seeing right now, no. We think that that's still going to apply, because if you still have C corporation tax rates that still would be lower than the higher personal tax rate, this is a way for them to level the playing field. So as far as we can see right now, that was on the table some time ago when Biden first took office. But as of right now, what we're reading is the QBI deduction will still be available going beyond 2021. Corey, you were going to talk a little bit about personal tax planning and a few things. We only have a few minutes. It doesn't look like there's anything in the Q&A right now, but I don't know if there was anything else you wanted to mention on this as well.
Yep. Can we go to the next slide? Here we just listed out the tax brackets for 2020. Some of those numbers were referenced. The main thing here is that 37% tax bracket. We don't know if that's just going to be replaced by 39.6% or whether 39.6% might just be a higher number there. Next slide, please. This is I like this slide because one thing that people don't know or realize, I think sometimes, is if your income is low enough, you can actually pay 0% right now on capital gains. And if you look for a married filing joint couple, if you have $10,000 of capital gains and total income of $80,000, that rate on that $10,000 of long-term capital gains is actually 0. So there's this like little loophole there, and then you'll go to 15, 20, and again, that top tax rate could go to 39.6% instead of 20%, based on Biden's proposals. Next slide, please. Year-end tax planning, Mark covered this in detail. Accelerating income versus deferring income, changing tax rates. Think about the 3.8% Medicare tax, net investment income tax, Obamacare tax. I don't know, call it whatever you want. All the same thing on investment income, and then an additional 0.9% on wages above either $200,000 or $250,000, depending on whether you're married or not. Next slide, please. Maximizing and accelerating deductions. Mark covered the business side of things. For individuals, you're talking about $25,000 of a standard deduction. So your itemized deductions got to get over $25,000. So you're talking $10,000 of state and local taxes, looking at charitable contributions, medical expenses, unreimbursed business employee expenses, and investment advisor fees are now not deductible for federal purposes. That could change, we'll see. But a lot more people are actually itemizing their deductions. One thing to be aware of is that New York State doesn't follow the federal rules, and they have different itemized deduction rules. So sometimes you still have to send your itemized deduction stuff to your CPA for New York State purposes. Other things you can do, I think you can pay up to 2 advanced mortgage payments, deduct some more mortgage interest if you want. Prepayment of state and local property taxes, that's really minimized by the SALT cap. And then also you can bunch your charitable contributions. So you might do 2 years of standard deduction and then make all of your charitable contributions for a 3-year period in 1 year, bunch it together, get over that $25,000. You could also do that through a donor advised fund if you don't actually want to give the money to charity, you want to dole it out over the 3-year period. Next slide, please. Here we are going over, sorry if you can hear my telephone ringing. I forgot to mute my house phone. Muted my cell phone. Annual gifts, you can gift up to $15,000 to each individual. So if you make 10 gifts of $15,000 to 10 different people, you're not eating into your lifetime gift or estate tax exemption. Lifetime gifts, again, 11.7 million, dropping down to about 5.8. Biden has talked about $1 million threshold. So that could change dramatically. You might want to think about making gifts to individuals before the end of the year. And then just to hammer home, death tax. If we have a death tax deemed disposition tax and it's subject to cap gains, that cap gain rate could be 50%-ish, as we've talked about many times in the presentation. I think we got our last polling question now. How is and Mark really wants to know this, how is your workplace handling where you work now that some restrictions are being lifted? Completely work remotely, working hybrid, or required to work in the office full time? This is a discussion we are having every day at work.
I think every office is having this question. This is a big issue with employers and employees. So
we are being as flexible as possible right now. That's our answer. Look at that. Wow. 83% hybrid.
Okay.
I think it's going to stay that way for a little while.
I think so too.
Anybody have any questions? Type them in. We got chat. We got Q&A.
Yeah, but I think in closing, Corey, if anybody has any questions, please type them in. But in closing, it's really, especially if you're a small business owner, boy, you really got to keep your eye on what's going on, or you're a high net worth individual and you've got over $11 million of assets, there are some big changes potentially on the way. They're going to, you know, all the government subsidies that are happening, whether you agree or disagree with them, some of them are happening. And certainly, you know, infrastructure in the US, I think a lot of us would agree has to be, you know, continually built and rebuilt, and that's expensive as well. Well, it's got to get paid for some way. So taxes are going up somewhere. We just don't know exactly where. We thought that this was a good initial discussion. We hope to, you know, by the end of the year, or certainly well before the end of the year, to have more concrete answers for you on what those, you know, what they end up deciding on or what they end up agreeing on. But it's going to be, there's going to be a lot of political wrangling over the next few months about these items. And it's really important, you know, especially that capital gains issue could be absolutely monstrous for some people if you're considering selling a business. So just keep an eye on that.
And please don't sell your entire stock portfolio.
Yes.
I don't think that's a good idea. But yeah, I mean, Mark, I hope you're right and we get some time to plan, but with the nature of our government in terms of not being able to compromise the last 10 years, I mean, if you get one senator digging in their heels on the SALT cap that won't sign off on Biden's plan unless he puts it there, we may not have an answer until the 11th hour. So yeah. You contact your advisors, legal, accounting, get a flexible plan in place for the uncertainty, and cross your fingers that we get time to react to an actual tax law, and that it doesn't come on December 25th or something like that. That would be interesting.
Yes. Well, I guess with that, thank you everybody for the opportunity to speak. And if you have any questions, you've got our contact information. Please contact us anytime. We can discuss these further.
Thanks, everyone.
Thank you.